Bullsandbears.com. Bears are as profitable as bulls. Welcome to the Secular Bulls and Bears Each Requires Different Investing Strategies workshop, to be given by Mr. Michael Markowski. Before we get started, let me introduce myself to you. My name is Reeve Markowski, and I am Mr. Markowski's son. Since graduating from Florida State with degrees in accounting and finance, I have been an analyst for Bullsandbears.com. My father has been in the capital markets since 1977. He has experience as a stockbroker, venture capitalist, investment banker, analyst, portfolio manager, algorithm developer, and writer. He is widely recognized as a market crash expert. There have been many articles written about my father. Forbes.com reported on his ability to accurately predict bankruptcies for seemingly healthy and highly recommended public companies. SmartMoney.com named him the best stock picker on Wall Street and asked the question, is Michael Markowski the 21st century's reincarnation of Benjamin Graham? Fortune magazine named him as one of their 50 great investors. His sole stock pick that he gave the Fortune reporter, WebEx, was subsequently acquired by Cisco for a 200% gain. This is the title of the October 2018 press release by the producer of the interview of my father, which was aired on Fox Business Channel. During his interview, which was taped on September 11, 2018, he predicted the market crash and also the 6 tech stocks that would cause the crash. The 6 included the 5 original FANG stocks: Facebook, Apple, Amazon, Netflix, Google, and Microsoft. The addition of Microsoft resulted in his creating of the FANG-AM acronym. Here are the headlines for some of the articles about the FANG-AM stocks causing the October crash. The New York Post summed it up: stocks tumble on weak results at Amazon and Alphabet. This table depicts that all FANG-AM stocks declined by double digits in the fourth quarter of 2018. 3 of them, Apple, Amazon, and Netflix, declined by 35%. The 2018 crash prediction was not my dad's first, nor was it his most famous. In his September 2007 Equities Magazine article, he predicted that a day of reckoning was coming for the 5 largest brokers, including Lehman, Bear Stearns, and Merrill Lynch. My father also has a good track record for calling market bottoms after crashes. After the market crash in August of 2015, he said buy the market in his Equities.com article. In an Opportunist Magazine article in December 2015, he accurately predicted that the market would go to all-time new highs in 2016 and that the world markets would be entering their best 5-year period ever. Without any further ado, here's my father, Michael Markowski.
Thank you, Reeve. The subject of my workshop here today is Secular Bulls and Bears. Each requires different investing strategies. All of the slides from the workshop are available at bullsandbears.com under the Research tab. Now, this bar chart depicts the 16 secular bull and bear markets since 1802. A stock market is always in either a secular bull or secular bear phase. The chart depicts that when each secular bear ends, a secular bull begins, and vice versa. The market, as depicted by the green bar at the far right, has been in a secular bull since March of 2009. It was preceded by a secular bear, as depicted by the red bar just on its left, which began in March of 2000 with the bursting of the dot-com bubble. The 2000 secular bear ended when the bear market bottomed in March of 2009. This table depicts the durations for all of the secular bulls and bears. The longest bear was 20 years, from 1929 to 1949. The longest bull was also 20 years and was from 1861 to 1881. The shortest lifespan for both the secular bull and bear since 1802 has been 8 years. Now, for 104 of the 218 years, the market was in a secular bear, and for 114 of the 218, a secular bull. The average per annum gain for a secular bear was 0.6%, and for a secular bull, 15.3%. The average duration for a secular bull was 14.1 years, and for a secular bear, 11.6 years. Now, this here is a great chart. It's a classic bear, the 2000 bear. And after the 1982 bull peaked in 2000, the 2000 bear began and declined by 56% to its 2009 March bottom. Make note that it took until 2013, or 13 years, before the peak of the bull that ended in 2000 was eclipsed. This was very typical, and I will elaborate on this later. The 1982 to 2000 bull has the record for being the longest since the 1800s. The reason why is because the Berlin Wall fell in 1989 and Communist China opened up its economy in 1990. This resulted in there being hundreds of millions of new consumers of products produced by U.S. companies. The influx of consumers extended the secular bull. The bull and bear market terminology commonly used by the news media is applicable to cyclical bulls and bears, which are different species than secular bulls and bears. Here's a cyclical bear in the 1949 to 1966 secular bull. Here are two cyclical bulls in the 1966 to 1982 secular bear. Now, secular bull and bear markets are driven by sentiment. The blue line in this chart depicts that the Dow Jones increased by an average of 7.5% from 1919 to 2020 based on its trend line. When the public is optimistic, as was the case in the Roaring '20s, the market gets significantly overvalued and above its long-term trend line for an extended period. When the public gets pessimistic, as was the case after the crash of 1929 and the onset of the Great Depression, the market gets significantly undervalued and below its long-term trend line for an extended period.
And that's, so sentiment will move this up and down above and below that trend line. But that's the trend line. The market cannot, over long-term periods of time, grow at a double-digit pace. So if anybody tells you that, they don't understand what they're talking about. Because if you'd bought stocks at their Great Depression low, 86 years ago or so, you would have had a compounded annual return of 7.75%. If you bought it in 2008, your compound return was 7.8%. So it's not going to get above trend ever. Now, what is it that's driving? What is it that drives that trend in the market's growth? There's two things. It's population growth, and there's the one thing, and I'll tell you about the second thing in a minute. But you can see here, this is Japan here, and Japan in 1990, its working age population peaked, its total population peaked in 2010, and you can see how it fell off there, the working age clearly a peak in Japan in 1990, and its population has continued to shrink. Now, here's the second thing. It's the inflation rate. So if you add up inflation and population growth, what does that add up to? That adds up to, on a historical basis, probably the same numbers I showed you with the S&P. If you add up inflation and population growth, that gives you the total growth the market's going to grow. Because the reality is, without the population growing faster, without the population growing faster, there's only so many Oreo cookies that one can eat. So, there's only so many cars they can drive. So the markets are based upon inflation and population growth. Why is that important? Here's the Nikkei, all-time high. Oh, it happened to peak right when the population, the working population growth peaked. It peaked the year before. And look what the Nikkei's been in a secular downtrend since 1989. And it's the only market in the world that's never gotten back to its highs, never made a new high. And now it's 30 years now. And that's the Nikkei. Now, let's talk about population growth. Here's the annual world population growth, 1950 to 2100 projected. So, this is not a good sign with the world population growth, contracting in terms of the growth. it's not a good sign for the markets. Now, here is the population growth for the world, the more developed regions versus the developed regions. So it's not really helping. I mean, there's not any region of the world that's got population growth. The world's the population growth rate is declining, and it's declined to less than. In fact, in the U.S., they just reported last year it's the lowest it's been in 30, 40 years. The population growth rate. Okay. By the way, here is U.S. population. Okay, and you can see here that this is through 2018. It's gone below that, but it's been in a steady downtrend as well. U.S. population growth. Now, the issue here, this shows you the immigration population growth, which is the green line at the bottom, versus the gold line, which is the actual natural population growth. And the country has definitely clamped down on immigration, and that's going to hurt us on a long-term basis. I mean, we're doing everything we can to try to be very careful who's coming on our borders. That doesn't bode well for the United States. Here's the United States inflation rate from 1990 to 2019. It's consistently going down as well. The U.S. inflation rate. Here it is. Here's the inflation rate by year 1914 to 2019. Okay, so you can see it's definitely inflation is very, very difficult to get inflation going, and that's why the Fed, it's inflation or bust. I mean, everybody, if you monitor the Federal Reserve, I mean, every one of his speeches for every one of their meetings, he comes out and says inflation. We got to do something. We get inflation going. And why is that? The reason why is that governments use inflation to pay off their debt. If you don't have inflation, then you're not going to increase your tax revenue, and you're not going to pay off your debt. So it's critically important, not only for the market, but for the governments to have inflation, which is much higher than what it is now. Now, let's talk about, okay, we know that the demographics don't look good for inflation or population growth. So let's talk about what's going on with the economy. Okay, here's the cash freight shipments through December 19. You can see here that these things have come off. This is for December. This is for December for the last 10 years or so. But you can see that it's minus 7.9. That indicates to me the economy is going to slow. And that's the cash freight shipments. So let's take a look at what's the truckloads looking like. Okay? Well, this is the year over year. In December, it was down 3.3%. But look where it is. It's getting down over to here. It's getting down to getting close to over here. That's things coming, just dropping. What happened over here? Okay, we know that it was the crash of 2008. The whole recession came in on that. So that doesn't look good either over there. Okay? So this here is, let's see, I'm just looking at the, okay, this is the U.S. rail. This is the one I just showed you? I think it is, right? This is another one, okay. U.S. rail car loads, look where they are. They're, they're at their low. The president was elected in 2016, okay? And, we've been talking about this great economy, but hell, according to this, it's back to where it was before he was elected. So it does not bode well. So let's talk about private fixed investment percentage change from a year ago. Okay? So you can see here what this is the green line is fixed private investment, the red line is private residential fixed investment, and the other line at the top, which is the blue line, is non-residential investment. So you can see here, in this case that all of these, see if there's my mouse on here. Can you see it? Yeah, I want to show you this, okay? So you can see here that this is the recessions, okay? Each one of these are a recession. You can see here that these pretty much predict recessions. If you see this, boom, down here, recession. Even over here, boom, recession. It's the same thing, boom, recession. They come down, and you can see here, coming down here, that was the 2009 recession. And this over here is now what's happening now is we clearly peaked here. That was the peak of that. So all of these, there's very, residential saved the day in this one, non-residential, they're all going down. See that? All three of them are going down. So there's nobody that saved the day. Okay, there's no counter trends. We're in a fixed investment, and we're in a very we're in a difficult situation with that. Okay, now let's talk about the S&P 500 corporate profits after tax. Okay, and this here is, I want you to see here. This is, you can see here, get this in 2000, the S&P, which is in the dark line. The S&P, look what it did in 2000, and look what the corporate profits were doing. Okay? So corporate after-tax profits are here, that went to there, and then and of course, what the market followed suit, because you just didn't have the growth. So what happened is the market followed suit, went back up to here, got up to about 2000, and then they traded with each other. But look at the similarities in this pattern and this pattern. Can you see the similarities? Yeah, see that pattern? So corporate profits are after-tax profits are not growing at the same rate as the stock market. It's extreme overvalued. Okay. Now, this is very important because all the analysts I hear and the advisors and all that say, oh, the S&P 500, its PE ratio is not that high historically compared to other periods. Okay. I've been around this market for 43 years, and I'm saying to you the only thing that you can track on price ratios is revenue. Because revenue indicates, are they selling something? These companies can manipulate their earnings, okay, to make them and all this other stuff. But you can see here was the peak in the S&P 500 price to sales ratio, price to revenue. That means what's the value of the company compared to its sales. If the company is doing $1 billion a year in sales and is valued for $5 billion, it'd have a price to sales ratio of 5 to 1. Okay, so in this case, they're all in this case. You can see here that this is at an all-time high. This is scary, that this price-to-sales ratio, because it's telling me that businesses are being they're way overvalued based upon their sales. And the other thing about the PE ratio it will distort the multiples when the earnings come off. Also, the PE. So if you look at the PE ratios back for, 2000. And everybody's saying with the PE ratios, they're going back and saying, well, look at how high the PE. They're comparing the PEs today versus the high for 2009. Well, there was no earnings in 2009. That's why the PEs were so high. So this is really a serious issue to contend with here. Okay. Now, so let's talk about secular bulls and bear statistics. Okay, I showed you the chart earlier. Okay, so here is let's take a look at the secular bears. Look at the 1929 to 1949 bear, lasted 20 years, went down 93% from peak to trough. By the way, on the way down, if you think you're going to trade the market, on the way down there was at least 7 rallies of 50% or greater from the top to the bottom. Okay? And people got lured into those things. People lost their, okay, in that. But you can see here, the market did not get back to its 1929 peak until 26 years later when I was born. Okay, from 29, that was 26 years that it took for the market to get back to its peak. The 82 bear, the 66 to 82 bear, also, it took from to 1991, 25 years to get back to its peak. This one here, this bear, even this bear that we had here, the one that everybody thought recovered great, it took 15 years to get back to its peak. The one that the 2000 peak was not eclipsed until 2015. So the bears are, so I'm saying that, I would venture to say that everybody in this room is probably experienced their last bull market, okay, their last secular bull, okay, and we probably will not live, most of us will not live to see the top of the next secular bull. Now, I'm not saying the market's peaked yet, but the odds are that the market is going to go down and become a bear, because this bull has been around 11 years, this bull, okay? So can it go another couple of years? Sure, okay? But the what?
It's 18 years for the 82 to 2000.
Yeah, well, but again, I showed you that with why did that happen? I showed you. I'm a teacher, okay? Can anybody tell me why that happened?
Because of China.
Absolutely.
Berlin Wall.
Yes, absolutely. Communism fell. It was a big thing in the world. So the other thing I will tell you is a bear market, a secular bear, does not officially become a bear until the market has declined by 20%. So if you're waiting around for somebody to ring the bell and say, hey, we're in a secular bear market at the top, you can't measure it, okay? And it's got to decline by 20% and do certain things after it declines by 20%. Yeah. Well, let's go back here to that, okay? So you can see that I guess we've covered all that one, okay. Now,
What extent did the 49 to 66 one?
what did the what now?
The 17 years for the 49 to 66.
Well, look, what happened with that one is typically when you have a 20-year bear, it's followed by a multi-year bull, okay? If you look back at most of the bears are, all of the bears and bulls are 8 years old minimum, because it takes that long to establish a trend, okay? The trend. And okay. Now, what do you do, okay? What do you invest in? If we all know that sometime in this decade we're going to enter a secular bear, what do we want to do? Do we want to invest in gold? No. Gold doesn't really do anything because I found in all my research, gold doesn't do anything as an investment in bad times. Okay, that's what you think, but it really doesn't do anything. So gold is not a great investment. Well, people say let's diversify. If you diversify, we're going to be okay. I got mutual funds. You know how many people tell me, I'm okay, I'm in mutual funds, You know what I mean? I bet you nobody in this room has a mutual fund. But the point is diversification, it doesn't do anything, because when the market goes down, they take the piano player with them. Okay? Everything goes down when it goes down. So what you want is you want to have a strategy that's you want a crash protection strategy. It's the only fail-safe solution, and it's return of capital instead of return on capital. Okay? This thing, I don't know why it's automated, but I'm managing it. Okay? So that's what it is. Now, what is the first thing you want to do to deploy this strategy? You invest 80 to 90% of your money into the notes of 17 countries with minimum credit ratings of AA+. Okay? I say 80 to 90% because based on your age and your risk, the risk you want to take with your liquid assets, you may want to only put 80% into those notes instead of 90% of those notes. Okay? But I call it the 90-10 risk protection strategy. Here is the 17 countries. Now, why are these countries so important? Because all of these countries have demonstrated that they have paid their debts in recessions and depressions. So that's amazing. There's only 17 countries in the world that are AA or higher in credit ratings out of the 200-300 countries in the world. You would not want to invest in Greek bonds, okay? So the key is you want to invest in something that's going to return your capital because you ever heard of the full faith and credit of the U.S. government? You know, that's why the dollar's strong. It's so important, and all these countries have been able to do that, including Japan, Germany, and all of them. Okay. Now, what do you do with the other 10 to 20% of your assets? You invest in venture capital, high-risk stuff, okay? Technology startups, early-stage companies, penny stocks, okay? People say, well, what? You're going to be kidding me. Why would you want to invest in a penny stock? Okay, why would you want, if the market's going to crash, why would you want to invest in a penny stock? Well, the reason why, okay, or this, is because a small company, startup, early stage company, penny share company, they're typically small companies. So what happens is when the economy gets bad, like it was when I was started in this business in 1977. I mean, I was in that long bear in 1977. When the economy gets bad, I can tell you that the little fish will grow, and the big fish just die. They can't grow. So what happens, that's what compresses multiples. When the big stocks run out of room to grow because the economy is contracting, the only choice you have is really what you have is little stocks. And I'll give you a good example. When I was in 1978, that was right after Xerox had developed the copy machine. And at that time, these big copiers in schools and all that stuff, and it was pretty expensive, a copy machine. So Savin Business Machine, a company on the New York Stock Exchange trading at $2 in 1978, came out and started selling the first personal copy machine. Okay? And we had bought that stock for our clients where I was working for Merrill Lynch at the time. And that stock went from 2 to 50 while the market went down. Okay? Because it's a new technology. And in fact, if you go back to the Great Depression, there was all kinds of companies that made a lot of money. You could have made a lot of money in the Great Depression in buying new technologies like radio and TV and all that other stuff, while the big market couldn't get out of its own way. When I was in that recession, you didn't want to buy Ford Motor. I mean, it was coming out with General Motors. Forget it. Okay, so yes, you can make money. Now, here's a good example. Here's stock performance after recessions. Look at the performance of the small stocks versus the large stocks after recessions. The small stocks blow them away. Okay, the small stocks. So that's it. Now, this here is another reason why I like this, especially these low-price stocks, is because look at this. The S&P is just so overvalued. See, I want you to see the trend. The trend has always been the same all the way back to here to 1996. Yeah, the S&P gets overvalued. Then this one got overvalued, versus the S&P, but they're in the same range. They're doing the same trend. They both drop here. They both drop here, and then of course the small caps. Now this is when Dodd-Frank came out. When Dodd-Frank came out, it killed the small cap market, and it's made a lot of interesting opportunities. But look at here. Look at the divergence here for the RYLPX low price stock index versus the S&P. So this is where the money's going to be made when the market starts going down. Here's $10,000 investments in some of the well-known startups. If you had invested in these startups and their seed rounds, if you had invested $10,000 in Uber, it was $200 million at 12/31/17. That was 5 years later. And of course, Uber at $135 million, WhatsApp $73 million, and Snapchat $16 million in only 5 years in those situations. So there's lots of money to be made in startups. Now, this here is this is a good example. This is a chart I pulled out a few years ago, but you can see here there's 2 million apps out there that have been developed or in the process of being developed. Any of those apps could potentially be a home run, like the ones I just showed you, any of them. So there's plenty of them out there to invest in at early stage situations. Okay, here's something else. By the way, this is something that just came up recently that I monitor. I'm going to explain that in a little while, what I monitor at Bulls and Bears. But this here is, I thought this was very interesting. 50% of BlackRock's institutional clients who manage $9 trillion are increasing their allocations in private equity and alternative asset classes. Why are they doing it? Anybody have an answer for me? I'll tell you why. Because they know the market's at an all-time high too. They know the market's at an all-time high and extended. These money managers, they need to make money on a percentage of assets under management. If the assets go down by 50, 60%, they're not making any money. Okay? But if they invest you into alternative investments that go down when the market goes down, they still make their 1, 2%. That's why they're doing it. Okay? Now, here's Bulls and Bears right now. In fact, it just so happens that I'm a specialist in the non-public markets. I brought a company public, a private company, after we funded them many years ago for a valuation of less than $10 million. And it recently got acquired, and all of its shareholders have made over $1.5 billion. So the point is that I've got expertise in these private markets. I'm already in the position to capitalize on these private markets. Now, before we get into the next part, I want everybody here to understand that I'm very proud of this. Fortune named me as one of their 50 great investors in the United States. I have a track record to beat the band with making predictions. I've been in this market for 43 years. My years are numbered to continue doing what I'm doing. Okay. So guess what? Every year that I get along, every year that I grow older, I become more conservative in what I'm recommending. Okay, why? Because I've got 2 sons, including my oldest son back there, and another son. He's got a degree in accounting and finance from Florida State University, and I have another son who's graduating with a degree in finance. So I'm going to leave them a legacy. So I'm not going to do anything that I think could stain this. Okay? I'm not going to do anything to stain my reputation. I'm not going to do it. Okay? Now, why am I saying this? So the reason why is I'm going to show you bullsandbears.com, which provides ongoing research on leading and declining industries and trends. This is a site we put together just to track the trends, the new trends that are coming. So I'm looking always for new trends out there. And then we find the trend, we slap it on the site, and then we provide in-depth research on the trend. The tariffs are a good example. When the tariffs came along in 2018, we have all kinds of in-depth research on the tariffs. These are some of the other subjects that we cover on the site. Okay. The site also has screened information. I'm the editor of anybody who puts stuff on this site. I don't put anybody on this site unless I think you're going to make money following what they're doing. Okay? These are the guys I would use, okay, if I needed a money manager. Obviously I don't, but I mean these are the guys. So I have a great deal of respect for anybody I put on this site that's writing on this site. And that means, and there's not a lot of stuff either. Look, there's only there's probably an average of 5 stories a week. So you should go in and subscribe to the free alerts on this site and get alerted when these things come out, because you'll be more informed of the new trends and the trends that are declining, et cetera. Now, the site also has all these products that have been developed, okay, that are products for crashes, recessions, and secular bear markets. So you don't have to just sit out there and stay in the market. You don't have to. These are products. We have the Bull and Bear Tracker, an algorithm which trend trades long and short ETFs. By the way, this is my 4th algorithm. Remember I told you about Lehman, my son told you about Lehman before? Lehman, I made that recommendation on Lehman, Merrill Lynch, and Bear Stearns based upon an algorithm that I developed from doing an autopsy on Enron. So I'm saying to you, Lehman and Enron died of the exact same cause of death. Okay, so this is my fourth algorithm. We'll get into that if we have some time here. It's a trend trader that trades ETFs. It's generating about 5% a month in returns. That one. We have Perfect Shorts, which I only come out when the market gets at the all-time high and the bear is close and the bear starts. The Perfect Shorts, it's not even available right now as a product. It will not be available until we reach get into the secular bear. Shiny Pennies identifies stocks with upsides of 100% within 12 months and 500% in 5 years. Okay. Now, Techno Lease identifies tech equipment leasing opportunities which provide steady cash flow and tax benefits. We have a leasing opportunity now available that will generate it's a very low risk, high reward opportunity that's going to generate 20% a year, okay, for the next 20% a year, and you're paid monthly for the next 5 years, which is Techno Lease. And then we have Trophy Investing, which identifies, private equity stage companies with 10x potential within 3 to 5 years. And of course, we have Dynasty Wealth Investing, which identifies private equity startups with 100x potential. Those ones I showed you, like Uber and Airbnb and that stuff, that's what it does. It specializes in that. Okay, and it's a high risk, high reward offering. Dynasty Wealth. Now, speaking of, let's go back to what I told you about BlackRock. I saw this, and look at what the firm's ramping up investments in big data to analyze companies, right? Well, Techno Lease, okay, Techno Lease, the company that I've identified that's doing this, and you should definitely check this out, is what's it involved in? It's involved in big data. Big data is going to be the fastest growing technology industry for at least the next 10 years. Okay, and this explains how it all works. Big data. Okay, so Techno Lease has got a viable cash flow producing alternative investment. You buy the capital equipment, you buy the equipment and lease it. You get depreciation and everything. Here's the Bull and Bear Tracker's track record for January. It's up 5% versus 3% for the S&P 500. Negative 0.03%. It's up this month. It's up 3.7%. Wait a minute. Today's February. Today's right. We're not even into the month. Now, not only is it up 3.5% or so, but it's only been in the market for 2 days for the month of February. This is another interesting product. Here's the Dynasty Wealth. Here's the interesting thing about Dynasty Wealth. I showed you that stuff on Uber. Well, here's Uber. If you put your money in the seed round, your $10,000 in the seed round, you would have made $82 million. However, there's only 125 investors who could have put up $10,000. Okay? And if you put your money in the Series A round, which is, there's 1,100 investors at 10,000, they still made $6.8 million. So Dynasty Wealth's looking for stuff in the seed round and the Series A. This here is trophy investing, and trophy investing is this is one for the really, you can invest as little, we find startups at trophy investing you can invest as little as $100 in. I've got one right now that I'm going to post on the site this week. Okay, I've been tracking the company for a long time. I know them well. It's a fintech online broker which has been in business, and it's going to be the first one to be able to offer, first online broker in the U.S. to be able to offer crypto currencies and also private equity trading. This thing's going to multiply. It's going to just explode in value. And so we should have some. Daniela, can you get some tickets? We have some flyers somewhere. Maybe they're back at the booth. No, we actually have coupons here with the promotion code in it. Anybody here at this show, okay, go to Trophy Investing and submit. With a passcode, you can get 60 days free, 2 months are free for Trophy Investing, and take advantage of this opportunity that's going to be available next week. Okay, that's my presentation. Does anybody have any questions? Yeah.
Tell us about how your services work.
All of it's subscriptions. Most of it's subscription. Most of it's the subscriptions. Yeah. Yeah. We're not a broker dealer. We're not charging a fee based upon the transactions. It's it's basically subscriptions. We do have a lot of free trials on this site now because a lot of these, I've been working on this thing for 2 years. This is going to become the premier website for the bear market that's coming, for the secular bear. So there's going to be tons of people who are going to want to have access to this kind of information. Yeah?
If you were estimating how soon would you say the bear is going to hit?
I think it's going to definitely, it could hit after the election this year, could hit before the election this year. I think that the Trump, this economy is right on, setting on the edge. Anything could tip it downward. Anything, any kind of shock. I wrote an article about the virus, and everybody was poo. I said, you're crazy. This is really real. The market fell last week on that, but I still think that's a big risk. I think that we haven't seen the last of that, so I think there's things out there that definitely could cause the whole thing to tip over. You have a question?
Do you think last year Christmas Eve was a sign when the Dow Jones went down so far?
Well, it was, but it did not. So the point is there's two things that have to happen. Last year, the market went down 20%. So remember, a secular bear cannot begin unless the first thing it has to do is the market's got to go down 20%, but then the market's got to stay down 20% for an extended period of time. Yeah. Mm-hmm. Yeah.
This trophy investing in penny stocks, that's only with 10 or 20% of your money right now. If you were to say 90% should be in those treasuries.
Absolutely. I'm saying absolutely. I think if you're concerned about the market, you want to protect your gains, you want to protect your estates, you got to put 80% of your money. I don't care how good the deal is. You got to have 80% of your money has got to be in treasuries. Yeah.
How do you buy those treasuries in those 17 foreign countries?
You don't buy them in the 17. You buy U.S. U.S. is one of them.
17 countries.
What?
The U.S. is one of those.
The U.S. is one of the 17 countries. Oh. Yeah. And that's, by the way, that's why the interest rates are going to negative interest rates everywhere, because everybody's gobbling up all of those pension funds around the world are buying the debt in those 17 countries. The U.S. interest rates are going to go to below zero. Probably by the end of the year. They're going to be negative interest rates. So you want to, if you're going to do this strategy, you want to be proactive. Nobody's going to ring a bell and tell you that the market is at a top. You've got to be defensive. Again, the ability to put money in the private equity that can multiply and the startups, to put some of your money there, it can be worth more than your total portfolio by just having a diversified portfolio. So I want to thank everybody for coming today, and sign up, get some free alerts at Bulls and Bears and Trophy Investing. And Daniela has some free tickets here for you to sign up with, free tickets. And thank you very much.